in China and continuing debt issues in Europe as well. Joining us now is Axel Merk. He is president and chief investment officer of Merk Investments, where he manages $550 million in currency-focused assets. And Axel, you know, in talking with Dom here, I pointed out that this Chinese trade deficit issue is on a monthly basis, but you say on a yearly basis they're going to have a trade deficit as well.
Well, year to date they've had one, not throughout this year. That's a bit premature. That may take a little bit. But as the argument was just made, this takes the pressure off the revaluation. I think it may even increase it. It takes it away from the political side. The argument is more difficult to be made. But if China allows its currency to appreciate, those imports will become cheaper. And China is realizing that a stronger currency is the best way to fight inflationary pressures. Not only will it tame this economy that seems to be overheating, and they're trying to slow down, but it's a much better way to reduce this economy because the stronger exchange rate will create a normalization, will make those commodity prices cheap. And we realize both in China and in the US that yes, people do use commodities, and so it does have a real impact. It's affecting the global economy now.
Axel, speaking of the global economy, I kind of didn't know where to look this morning because there was so much news. You had the China unexpected trade deficit, you had German exports unexpectedly declining in January, you had Spain's credit rating cut, and then you had our weaker than expected jobless claims numbers. I mean, is the world kind of falling apart a little bit here?
Well, normally the markets can focus on only one issue at a time, and so the market got a bit overwhelmed here. Let's also remember where we've come from. We have months and months and months of rising S&P, and other markets have been going up, and so we are bound here to have a breather. But more importantly, in the greater context, the Federal Reserve has been talking about its exit strategy again. Well, there's no way we're going to have an exit from this easy money with these amazing headwinds we have. And the European ones, they shouldn't be a surprise at all. There was no magic wand, and we're not going to see one. The issue there is that will the issues in the peripheral country affect the euro as a whole? And we have argued that this weakness in the euro is great for German exports. Obviously, they're also facing the headwinds from these commodity prices. But overall, Europe is on a way of rising interest rates to fight those inflationary pressures. And in the US, we'll keep the money wide open in an effort to fight these things. And of course, all this open money will only continue to foster high commodity prices down the road, creating further instability in the world.
You know, just looking at the euro-dollar chart, Axel, the term weakness in the euro doesn't make any sense. I was actually over in Austria last week, and I was shocked every time I looked at my bank statement there. $1.38, $1.37 here. Where do you expect it to go? Does it continue to rise?
Very much so. Maybe not today. Obviously not today. But the point here is that this lack of bailing everybody out is precisely what is good for currency. It's bad for the peripheral bonds, but it's good for the currencies because less money is being spent and printed. That's why the euro is so strong. And while of course at some point they'll come to the rescue of this or that country, they are far more reluctant to do so than in the US, where we're just spending trillions to bail everybody out. Not maybe in the municipal market, but overall in the US we're just far easier in spending money than in the Eurozone. And they're actually making the right tough choices. And that will lead to less economic growth, a lot of social unease, potentially governments being thrown out. But as far as the currency is concerned, the euro is now at 137, 138 versus 118 about a year ago when everybody said the euro is going to parity. And it's getting stronger precisely because the governments are more reluctant to spend money.
But how can you say everything's going to be okay here, particularly for the euro? When I look at something like Spain getting another downgrade, I mean, Axel, isn't that something to be concerned about? I mean, Europe's problems have not yet been dealt with.
By all means, I'm not saying everything is okay. What I'm saying is that the problems in the Eurozone ought to be reflected in the spreads in the bond markets. We're not touching any Southern European bonds, but at the same time, we do buy the euro. But when we buy the euro, we buy Northern European debt. Now, obviously, everybody has a different risk profile and have different priorities. But it's one thing if a Southern European country has a problem, or the euro as a whole. And Trichet, head of the European Central Bank, makes that argument quite often. We agree that the U.S. economy is also hugely diverse, and there's a difference whether you give your money to Louisiana, California, New York, or the federal government. It's all the U.S. dollar, and it's different. Now, people say that there's no central government in Europe, and there's a problem with that. But the advantage of not having a central treasury secretary is that it's not as easy to spend money. There are advantages and disadvantages to it. But by all means, yes, we'll see ugly headlines coming out of countries dragging their heels and not getting their act together quickly enough.
All right, we've got to run. Hey, Axel, thank you as always. Axel Merk joining us there.